So as a business, you have general liability, professional liability, workers' compensation, commercial auto, commercial umbrella, cyber insurance, and more. That should cover everything you should need for your business, right? Not quite. Depending on the industry you work in, you may need additional risk mitigation tools. That's where bonds come in. Let's talk about that. Hi there, it's Kim with Barry Insurance. Business insurance is complex, and adding bonds into the mix can make it even more so. Here at Barry Insurance, we're experts in dealing with bonds, as we issue hundreds to our clients every year. So in this video, you will learn: what is an insurance bond? What is the purpose of a bond? What are the different types of bonds? How much does a bond cost? Does my business need a bond? How do I get a bond? Let's jump in. What is an insurance bond? Is it an insurance policy? Although bonds are generally lumped into the conversation with insurance, it isn't technically insurance. An insurance policy is an agreement between the insured, you, and the insurance company, where the company agrees to pay for certain claims in return for you paying a premium. A bond, or surety bond, is an agreement between three parties: the principal, the person purchasing the bond, the obligee, the person who receives the benefit, and the insurance company. An insurance bond is not meant to pay for claims. It is meant to provide a financial guarantee that the person or an entity purchasing the bond, the principal, will reimburse the obligee should the principal default or fail to fulfill its obligations or a claim is made. Simply, an insurance bond is meant to prove or support the financial stability of the entity purchasing the bond. It affirms that the principal will be able to repay the bond company if it pays out a claim. In most cases, when bonds are written, loss isn't generally expected. They are intended to work as an extra layer of protection in case the purchaser, the principal, is liable for not meeting the terms of any work-related agreements. What is the point of a bond? You might be wondering why the relationship of a bond needs to be a three-way relationship as opposed to an agreement between obligee and principal. The principal is responsible for paying anyway, so why does the insurance company need to be involved? And why would the insurance company take the risk of the principal not paying them back? Well, there is something in it for all three people in the party. For the obligee, a bond ensures that they will not be liable for anything if the principal doesn't meet contract requirements or pay its employees. The obligee is requiring a bond to ensure the insurance company will pay them if the principal can't. For the insurance company, they are paid a premium for the bond, similar to interest on a loan. They are not expecting to pay anything to the obligee, but they make some money out of the deal simply by being paid a premium for the principal. For the principal, the bond ensures the insurance company will pay if they themselves cannot. However, the expectation is that they will pay the insurance company back. The incentive to repay the insurance company is so that they can continue to be bonded and continue to get jobs. What are the different types of bonds? Bonds can be pretty confusing, but looking at a few examples might help make the explanation more clear. There are many types of insurance bonds, but the most common are public official bonds, license and permit bonds, fidelity bonds, and contract bonds. A public official bond is designed to guarantee that you will faithfully perform your duties of your office, whether elected or appointed. Typically, these are issues to persons responsible for handling money. Some examples of public official bonds are the tax collector, treasurer or assistant treasurer, town clerk, constable, or subordinate who handles money. A contract bond is used to guarantee fulfillment of your contractual obligations. Some examples of a contract bond are bid bond, which guarantees that if you are awarded a job, you will comply with the bid specs. This type of bond doesn't usually cost anything. A performance bond, which requires the contractor to finish a job on budget and on deadline. This type of bond is usually combined with a payment bond. A payment bond, which provides your subcontractors and vendors a guarantee that they will be paid for their work on a job. A license and permit bond is used to satisfy the requirements of a government agency, such as your local city or town. Some examples of a license and permit bond are a professional licensure bond, real estate license, insurance license, etc., a mortgage broker or lender bonds, notary bonds, private investigator bonds, auto dealer bonds, street repair, drain laying, demolition or street opening bonds, auctioneer bonds, collection agency bonds, travel agency bonds. Finally, a fidelity bond can be used to protect your business from fraudulent acts committed by your employees. Some examples of this include employee theft dishonesty bonds, janitorial service bonds, ERISA or Employee Retirement Income Security Act bonds, probate or executor bonds. Does my business need to be bonded? Depending on your contractual and regulatory requirements, you may need one or several of these insurance bonds. You may actually be legally required to be bonded per the state, an industry association, or a contract that you've signed. In addition, if you perform services in someone else's home or business, or you or your employees have access to money, you may want to be bonded for the extra protection. Finally, if you are involved in any construction work, you may also benefit from the additional protection of an insurance bond. How do I get bonded? As you can see, there are many reasons why you may want or need an insurance bond. Here are the steps to get a bond. You will need to reach out to your insurance agent or carrier to find out exactly what you will need. Depending on the bond, you could either need to complete a simple application or a more lengthy one. You may be asked to provide financial statements, resumes for owners, bank references, and details of your current projects and work in progress. Once your agent gathers all the necessary information, they will process it and issue your bond. Keep in mind, if you need to get a bond to satisfy regulatory or contractual obligations, you should begin the process as soon as possible. The process of obtaining a bond can take as little as 1 day to up to several weeks. How much does a bond cost? Pricing can be tough to generalize since there are different types of bonds and their pricing is based on various specific factors. The cost of a bond is based on many factors including the type of bond needed, industry experience, the financial stability of the entity or employee being bonded, credit score, and more. The price mostly depends on the contract amount of the bond. Most bonds can cost somewhere between 0.5% and 20% of the value of the bond. Running a business is tough, and I'm sure you do a lot to protect it. Bonds are simply another risk management tool to ensure you are properly meeting your business obligations. There are many types of bonds that we did not cover in this video, and just as many scenarios where you may need them for your business. If you would like to learn more about bonds, reach out to an insurance agent to discuss your specific situation. However, if you want to do some research yourself, feel free to check out our Learning Center on our website. We have various articles and videos about bonds as well as other insurance topics. Thank you for watching today's video, and if you learned something or found it helpful, please consider liking this video and subscribing to our YouTube channel. We make videos like this every week to help educate our viewers on the world of insurance. Thanks again for watching, and we will see you in the next video.